Hello guys, so I'm going to use this video to explain the candlesticks pattern that we have discussed earlier. So we talked about 10 candlesticks pattern. We talked about the bullish engulfing pattern, the bearish engulfing pattern, the piercing pattern, the shooting star, the dark cloud cover, the Amma, the doji, the bullish and bearish Harami, and we also talked about the morning and evening star. So what I'm going to do is that in this video I'm going to explain and illustrate to you how these patterns form on your charts. So first thing for I want to also use this video to explain the concepts behind the support and resistance. So resistance is an area on your chart that resists, that does not easily allow price to go through it. So as you can see, this black line at the top of this place is my resistance over here, and the support is an area on your chart that does not allow price to pass through it easily. So we have a selling pressure around the resistance and buying pressure around the support. What it means is that when price is moving to resistance, you will have sellers that are willing to take profits around this price, and when price is moving down to support, you will have buyers that want to buy in at a lower price so that they can sell back at higher price at around the support. So usually price move from support to resistance, support to resistance, support to resistance, like this before it breaks out or breaks down. So that's how price moves in a support resistance channel. So all I want you to note is that support is an area on your chart that buyers usually starts buying so that they can sell higher, and resistance is an area on your chart that sellers sell to take a profit in order to buy back lower at support. So I'm going to discuss more about the concepts of support and resistance in my next video, but in this video we are going to focus on candlestick patterns. So the first candlestick pattern I want to talk about is the bullish engulfing pattern. But before that, I want to talk about the two key important aspects of candlestick patterns of candlesticks. So the first thing you want to note on your candlestick is the body of the candle, which is usually green or red. So the body of your candle, for a bearish candle, the price opens from the top and moves down lower to the bottom. That's how bearish candle forms. So sellers push the price from top, from resistance to down to support. So that's how a bearish candle forms on your chart. So for bullish candle, the price moves from support, that is from a low price level to a high price level. So the price moves from, let's say, this point. Let's say the price came like this, open at this point. So I'm going to use green for my bullish candle. So let's say the price opened at this point. So sellers start to push it down, then it reverses back higher and start going up to resistance and form. So your bullish candle opens from the bottom and close at the top, while your bearish candle opens from the top and close at the bottom. So that is it about the bearish and bullish candlestick pattern. And this red and the green parts of the candle are what you call the body. So the body shows you how strong the candlestick is. If the body is red, it's telling you that the momentum of the candle is bearish. If the body is green, it's telling you that the momentum of the candle is bullish. So sometimes you can have a black candlestick which is bearish and a white candlestick which is bullish, but generally it is always represented by red and green. So another aspect of candlestick pattern I'm going to talk about is the wick. So how does the wick form? So let's say sellers are pushing price down from the top. So they are pushing the price down. Let me use red candle. So let's say sellers are pushing price down from the top. Let's say from here around the resistance, they are pushing it down to support. And once it gets to support, then buyer starts coming in and they push the price back up to here. So to show that the buyers have pushed the price up, you will see a line like this. We call it the wick of the candle. The wick of the candle, what it shows you is a price rejection. So you have the body of the candle, which is the color part over here, and the wick of the candle, which is the black line over here. So the wick shows you a price rejection of higher or lower prices. Let's do another example. Let's say buyers are pushing the price up from this point. From this point, they are pushing it to resistance. Then sellers start coming in and they push it back down. So what you have to show that sellers have rejected the higher prices is the wick of the candle, which is over here. So you will see the wick of the candle. The wick shows you price rejection of higher and lower prices. So this one is showing you price rejection of higher prices. That means sellers does not want the price to go above resistance. And this one is showing you price rejection of lower prices. That means buyers do not want the price to go below support. So they have rejected it. And the wick, the ratio of the wick to the body shows you who is in control. If the wick is longer than the body, it tells you that there is a strong price rejection. If the body is larger than the wick, it tells you that the rejection is not that strong. So let's move on to the candlestick patterns right now. So the first one we are going to talk about is the bullish engulfing pattern. So for the bullish engulfing pattern, the first candle that forms is a bearish candle. So let's say the first candle opens from here and sellers start pushing the price down to this low over here. Then what happens next is that the next candle that is going to form is a bullish one, and buyers come in, and the next candle is going to cover or engulf the last candle. So you have the bullish candle, which is the green candle, covering or engulfing the red candle, which is the bearish candle. So it's showing you that buyers are in control, that buyers have rejected lower prices. So the next candlestick pattern I'm going to talk about is a bearish engulfing pattern. So for bearish engulfing pattern, you have buyers pushing the price up to some extent, let's say up to here. Then the next candle that is going to open is a bearish candle, and the price opens from this point, and sellers start pushing the price down, and the next red candle engulfs or covers the first green candle. So the first one over here is a bullish engulfing pattern, and the second one over here is a bearish engulfing pattern. The reason it's bullish and bearish engulfing pattern is that for the first one, the bullish candle is engulfing the bearish candle, and for the second one, the bearish candle is engulfing the bullish candle. That's why you call it bearish and bullish engulfing patterns. So the next candle I'm going to talk about is the piercing pattern. So for piercing pattern is a bullish reversal pattern. It's a weaker form of a bullish reversal pattern. So what you have is that you have the sellers pushing the price lower, let's say up to this point, and then buyers come in and start pushing the price higher. Let's say from here, buyers come in and start pushing the price higher, but it did not cover the first candle. It did not cover the first candle. It just went like 50% of the body of the first candle. Let me do it again. So first of all, you have for the piercing pattern, you have sellers pushing the price down. They are pushing it down. Then buyer steps in. And start pushing the price back up. From this low, buyer starts pushing the price back up, but it did not engulf the bearish candle. It only covered about 50% of the body of the red candle, and that is what we call a piercing pattern. It is a weaker form of bullish engulfing pattern. You know, for the bullish engulfing pattern, the bullish candle engulfed completely the bearish candle, but for this one, it did not cover it completely. It only covered it about 50%. So the next candlestick I'm going to talk about, I'm going to illustrate how the candlestick patterns form. I'm going to talk about all the 10 candlestick patterns that we have discussed. I'm going to talk about the bearish engulfing candlestick pattern, bullish engulfing, the shooting star, the Amma, the piercing, the dark cloud cover, the bullish and bearish Harami, and the morning and evening star. So let's get on to it right now. So the first one I'm going to talk about is the bullish engulfing pattern. So for bullish engulfing pattern, you have sellers pushing the price down from resistance down to support. So once the price goes to support and the candle closed around the support, maybe you have a little price rejection. Let me use a little wick to show the price rejection. Then the next candle opened, which is a bullish candle. The next candle opened. You know, this is a 4-hour time frame. So after like 4 hours, the next candle opens from the bottom, and buyer starts pushing the price up, and they finally push it to engulf, to cover the red candle. So the bullish candle, which is the green candle, is engulfing the red candle, which is the bearish candle. So that's why they call it a bullish engulfing pattern, because the bullish candle is covering the red candle completely. So the next candlestick pattern I'm going to talk about is what I call the bearish engulfing pattern. So for bearish engulfing pattern, is just the opposite of the bullish engulfing pattern. So you have buyers pushing the price up. Let's say from here, they start pushing the price up. down up to resistance, and the candle closed, and you see a little price rejection, which I indicated using a wick. So you see a little price rejection to show you that the price has reacted to resistance. Then the next candle that opens is a bearish one, and the seller started selling. The seller starts selling, and the bearish candle engulf or covers the bullish candle. So you have the bearish candle covering the bullish candle, engulfing it completely. So that is how your bullish and bearish candle, that's how they form. So the bearish engulfing pattern is just the opposite of the bullish engulfing pattern. So for the bearish engulfing pattern, you have the bearish candle, the red candle, covering the bullish candle completely. So the next candlestick pattern I'm going to talk about is the piercing pattern. So piercing pattern is a weaker form of a bullish engulfing pattern. That means if you see it on your chart, it is also called a bullish engulfing pattern, but it is not as strong as a bullish engulfing pattern. So for piercing pattern, you have sellers pushing the price down from the top. They are pushing it down. You can see the way the price is going. The candle is going down, down, down. So it came to an area of support right here, and you have a little price rejection to show that sellers want to start, buyers want to start coming in. So I indicate my price rejection using a small wick. So what happened next is that the next candle that opens is a bullish candle, showing you that the buyers are stepping in. So the next candle that opens, it opens like this, and buyers start pushing the price up to like 50% to 60% of the body of the previous candle. So they push it up to 50% of the previous candle, and it closed. So we say that it is a weaker form of a bullish engulfing pattern, because over here you can see that you have a bullish candle covering the bearish candle. Over here the bullish candle is trying to cover, but it did not cover it completely. So that's why we call it a weaker form of a bullish engulfing pattern. So the next candlestick pattern I'm going to talk about is a dark cloud cover. So a dark cloud cover is a weaker form of a bearish engulfing pattern. So you have a bullish candle going up to resistance, and you have a little price rejection over here. So I'm going to put a little wick at the top to show you that there is a price rejection, and then you have the sellers start coming in at the top of the candle, and they start pushing it down. They start pushing it down up to 50% of the candle. So it is a bearish engulfing pattern, but it is not as strong as the main bearish engulfing pattern. This is the main bearish engulfing pattern. This is the dark cloud cover, which is not as strong as the main bearish engulfing pattern. It is a weaker form of the bearish engulfing pattern. So that is how it forms on your chart. So the next candlestick pattern I'm going to talk about is the Amma. So the Amma forms like this on your chart. So you have sellers selling from here. They are pushing the price down. So immediately the price gets to this support, then buyers start rejecting it, and it forms like this. So you have something like this and a wick like this to show you that there is a stronger price rejection. So the Amma is a bullish engulfing pattern. It has two types. Another type of Amma is this. So you have sellers, let's say from here, they are pushing the price down, and once it gets to the area, they started pushing it down from this point. So let's say that point is $5 on your chart, and they push it to like $3. Once it gets to $3, buyers at around support, buyers starts coming in and they push the price up above $3, let's say to $4, and you have the candle close, and it's going to turn green because the buyers were able to push the price above the opening price. So these two candlesticks pattern are both Amma. They are both bullish pattern, but the thing is that the green one is a little bit stronger than the red one, because for the green one, the buyers actually push the price a little bit above the opening price of the candle. So let's say the price opened at $3, the buyers were able to push it above $3, maybe to like $4. That's why the head is green. So that's for the Amma. The next candlestick pattern I'm going to talk about is the shooting star. So for shooting star, you have buyers pushing the price up. Let's say they are pushing it up from here. They are pushing it, let's say from $5, they are pushing it, and they push it up to $3. Then sellers starts coming in. And they push it back down to like a little bit down. Then you have a price rejection around like this. So that's a shooting star or inverted Amma. You can call it inverted Amma. It is a bearish engulfing pattern. It is a bearish reversal pattern, sorry. So another variation of shooting star, let's say you have the price open at $5 and buyers are pushing the price up to resistance. So once the price gets to resistance, sellers immediately comes in and start pushing the price down down to like maybe $4. So once they push it to $4, you will have a red shooting star, because the sellers were able to push the price below the opening of the candle. So over here you have a shooting star, and the green over here you have the Amma, and the green one is stronger than the red one. They are both bullish reversal pattern. And over here you have the shooting star. This red one is stronger than the green one, but they are also both bearish reversal pattern. So the next candlestick pattern I'm going to talk about is the Iramming candlestick pattern. So that one is what we call an inside bar. So first of all, I'm going to talk about the bullish Iramming. So let's say the seller starts pushing price down up to this point. They start pushing the price down up to that point, lower, and you have a little price rejection around the support. So what happens is that the next candle that is going to open is going to be an inside bar, a bullish candle. A bullish candle is going to open. So it's going to open somewhere here and a little bit to the top like this. So once this candlestick pattern is a bullish reversal candlestick pattern, so what it actually tells you is that volatility is going to increase in the market. Volatility is going to increase. That is You know, when volatility is decreasing, you see your candle starts getting smaller. So it's trying to tell you that volatility is going to increase upward. So the next candlestick pattern I'm going to talk about is the bearish Harami. So for the bearish one, you have a buyers pushing the price up. Let's say they are pushing the price up to this point, and you have a little price rejection. Let me use wick to show price rejection. You have a little price rejection, and then what happens is that the next candle that opens is an inside bar. That means it opens inside the previous candle. So let's say it opens here and you have a little bearish candle. So this one is a bearish reversal pattern, and it tells you that volatility is going to break down. This one is telling you volatility is going to break up. So Iramming just tells you about a volatility. Once you start seeing it on your chart, you know that volatility is going to expound towards up or down. So that is it. We call it inside bar because this candle, this smaller candle opens inside the bigger candle. Unlike this one over here, you can see it opened outside the bigger candle. So the next candlestick I'm going to talk about is the doji. So what doji means is that there is equilibrium in the market. The rate of buying and selling is equal. So you see doji on your chart, it looks like this. It looks like this, just like a cross on your chart. It could be red, it could be green, but let me use black for this video. A doji could be red, it could be green. What it's telling you is that there is indecision in the market. Both buyers and sellers are both in equilibrium. So there are two types of doji. We have the Dragonfly Doji. The Dragonfly Doji, which is a bullish reversal pattern. It looks like an Amma, but it's not really an Amma. So the Dragonfly Doji looks like this. Or there's another variation of it that also looks like this. Okay. So the Dragonfly Doji looks like that, and a second variation of it also looks like this. Let me do it from here, then to the up. And the candle that the little body of candle that is going to be on it is going to be green. So the green Dragonfly Doji is a little bit stronger than the red Dragonfly Doji. They are both bullish reversal candlesticks pattern. So the next type of doji I'm going to talk about is the Gravestone Doji. So the Gravestone Doji is a bearish reversal pattern. You have it like this, facing upside down, and you have a little candle body that just cross it a little bit like this, and that is telling you that buyers have rejected, sellers have rejected higher prices. For these ones, buyers have rejected lower prices around support. Then for these ones, sellers have rejected higher prices around the resistance. So the next variation of a Gravestone Doji looks like this. Let me do that again. The next variation of a Gravestone Doji looks like this, and you have the body of the candle. You have the body of the candle as red. So they are both a bearish reversal candlestick pattern. So the next candlestick pattern I'm going to talk about is the morning and evening star. So for the morning star, you have a bearish candle like this, a bearish candle like this. Let me do that again. For the morning star, you have a bearish candle like this, let's say like this. Then the morning star makes up of 3 candles. Then the next candle you are going to see at the bottom here is actually a doji. So you are going to see it like that, showing you that indecision in the market. And what happens next is that buyers stepped in within from the third candle and pushed the price up above the first bearish candle. So for this one, the first candle is bearish, telling you that sellers are in control. The second candle is a doji, telling you that there is indecision in the market. Both the rate of buying and selling are both equal. And the third candle just take the price higher, telling you that okay, after the indecision in the market, finally buyers took control. So that's it about morning star. So for evening star is just the opposite of morning star. For evening star you have a bullish candle. Buyers are pushing price up, so it got to an extent at the top. Then you have a doji appears, showing you that there is currently indecision in the market. Buyers and sellers, no one is in control, they are both in equilibrium. And the next candle that opens is a bearish candle. And sellers took control and push the price down lower. So this one is a bearish reversal pattern, and this one is a bullish reversal pattern. You can see for this one, the bearish candle is engulfing the doji, and for this one, the bullish candle is engulfing the doji. So that is it about a candlestick pattern. I hope I've been able to use this video to explain and make you understand the candlestick patterns more better.